Andrew Milligan is head of global strategy at Standard Life Investment, and he helps oversee more than $250 billion. Thank you so much for joining us on the program, Andrew. I like the way you say there are opportunities as long as we actually can get hold of the crisis and the politicians come together. What is the percentage that actually the governments will deal with this crisis in good time, and what are the chances that this will unravel, that Greece will default, disorderly default, that the markets will have to and the banks will have to capitalize?
I think ultimately the success of government policies is pretty much determined. I mean, every single time an analyst looks at the difficulties facing a country leaving Greece, leaving European Monetary Union or having a messy default, the impact on global GDP was just be so great that I think the politicians will eventually come through, as we saw at the IMF meetings over the weekend. The difficulty will undoubtedly be the uncertainty along the way. We've got some very grandiose statements which politicians have announced. Now we get down to some of the very hard details, some of the earlier discussion you had before about the size of the haircuts or how the FSF is going to be leveraged. So I'm sure we're going to be seeing certain days where the markets are down very sharply indeed on the back of continuing worries.
But
ultimately,
term,
we think the politicians will come through.
And so in the longer term, it means that you see also buying opportunities in equities. Talk me through your ideal portfolio right now. How much do you have in cash, and how much would you have in European equities compared to emerging markets equities?
Well, I think, with respect, you shouldn't be thinking of a portfolio that is heavy equities and light cash, and not thinking about a number of other asset classes that are out there. For the investor who is looking short-term, there are undoubtedly some buying opportunities in equities. The degree of capitulation that we've seen in markets in the last couple of weeks is quite profound. But for the more medium-term investor, we're saying to them, sustainable yield is the line they should be taking. Can you get some good yield from commercial property, some good yield from corporate bonds, non-financials, and some good yields from equity markets, certainly here in Europe and especially the UK, but also parts of Asia, and put that together into a more balanced portfolio that will be able to protect you from some of the undoubted swings that we're going to be seeing in markets over the next few weeks and months, and provide some good income for you, with also the potential of some upside as and when the deleveraging process, the risks of a double-dip recession finally disappear. Our position in European equities at the moment is light compared with the other markets. We prefer the UK equity market and the US equity market to the European at the moment, as we do think there is going to be further volatility ahead. At some point we'll be looking to turn our position in European equities around, but not simply on the back of some grandiose statements by the IMF and G20 meetings.
And on UK equities, you actually quite like this market because of improved valuations and at the same time a lowering of sterling, which benefits exports?
Yes, I mean, many people make the mistake about the UK equity market of thinking it is as too domestically determined, and of course the UK economy is not performing well at the moment. But there are a number of very attractive international stocks based in the UK. We, in the last couple of months, have been putting so much emphasis as investors into thinking about the problems facing Europe or the problems facing America with its credit rating downgrade in the summer, of course. But the global driver of growth remains China, remains the emerging market economies, and not just in the UK, but a number of European stocks, the Nestle's, the BMWs, the miners and the oil companies in the UK. Collectively, they provide some very good opportunities for investors to take advantage of that global economic expansion centred on the Pacific region rather than the Atlantic region.
Okay, now Andrew, let's just take a closer look at your US position, because you're actually neutral on treasuries, saying that yields are being kept in line by limited inflation and central bank action, but the fiscal outlook is cause for concern. Now on equities in the US, you're heavy, citing good cost control and continued export demand, and you're also seeing value in the dollar as well. Are you not concerned that the US has an almost bigger chance of recession than what we're seeing here in Europe?
I think on balance the US has got a little more flexibility for several reasons. Firstly, the reduction in mortgage rates should be leading to some refinancing activity, helping household incomes. The fallback in oil prices has more of an impact in terms of gasoline in America, again supporting consumer incomes. And we are seeing the last vestiges of fiscal easing in America with Obama's jobs package. So on balance, we think the likelihood is that the US economy will be growing a little more strongly than the European economy will over, say, the next 6 to 9 months. But certainly we're not in a very heavy position in US equities. We're still quite cautious about a number of the risks. And one of those undoubtedly relates to the fiscal outlook for America. In many respects, all Europe is doing is coming to terms with its debt mounting. Those decisions face America either in 2012 or more likely in 2013 after the election. They will need to take some very decisive action indeed. The debate has begun, but it's still got a very long way to go to America. So if Europe is sorted out in 2011, let's wait and see if America is sorted out in 2012 or 2013.
But overall, Andrew, in terms of the U.S. equities, why do you think they're actually more attractive than European ones? I know you mentioned that actually it's the domestic stocks which aren't looking very attractive because of a difficult housing market, but you basically think that valuations and cost control are the key for making these U.S. equities just that little bit more attractive.
Absolutely. At the margin, they're a little more attractive. American companies still have a little more flexibility in terms of their cost base, their ability to outsource than European companies do. Many European companies are unfortunately in the situation where there is some forced selling taking place. As investors say, I really am very uncertain indeed about what the politicians will do in Europe. I want to be out of European equities, so I want to reduce my position in European equities. So we're seeing some forced selling in those stocks. And then on certain days, like the last couple of days, investors really move back into those stocks quite quickly as well. So it's just at the margin we think American stocks have got a little more advantages than their European counterparts. But if we did see a grandiose plan on Europe coming through within the next 6 weeks, we may well turn our position around.
But you're actually neutral on US Treasuries, and this is because the fiscal situation, despite the fact that we're seeing much more quantitative easing over there than we're seeing here in Europe.
Well, the last version of quantitative easing, Operation Twist, we're really very worried about indeed. I mean, all that the Fed is in effect doing is trying to alter the shape of the yield curve, certainly to the advantage of the 30-year bond. Unfortunately, we took advantage of that in our absolute return funds and some of our other positions where we were a very long duration and took advantage of that yield curve change. But going forwards, we have to say that currently the United States does not look to be expanding any more QE. And indeed, it's more likely, I think, that the United Kingdom and the ECB will be carrying out further versions of quantitative easing. So the whole QE debate, I think, has shifted a little way away from America towards the other countries.
All right, thank you so much for all your comments. That was Andrew Milligan, Head of Global Strategy at Standard Life Investment, joining us live from Edinburgh.